Hackers, it's Chris, Life 180, and I am hopping on here to do a live talking about life insurance as an asset, talking about kind of going through. This week was pretty inspired with a lot of interesting comments on the YouTube channel. And so I thought it would be fun. And I started this a couple of weeks ago to just kind of do a weekly session talking about just going through, answering, doing a Q&A session, and also answering any of the questions that came through the YouTube channel. And a couple of the questions got me to title this live as life insurance as an asset because of the fact that a lot of people were questioning it. So without further ado, I want to get into this one question. I'm going to just like hit the ground running here and we are going to go from here. So you can see here, this question right here. So I did a video talking about infinite banking for beginners. Now, if you haven't seen it, it's a really, really good video, I think. And it basically talks about infinite banking from a simplified perspective. It helps really break down the simple components, the nature of how infinite banking helps you operate more efficiently in your financial life, right? And in this, I use the example of how to buy a car more efficiently and the different ways that people go about making major capital purchases like buying a car in that instance. And so, the idea, the summary is some people save and then spend it all, i.e. they're cash buyers, and some people are debtors. They don't save, they go into debt, they get back to zero, they hopefully pay the car off, and then they recycle and they keep going. And infinite banking is basically kind of combining the best of both worlds to create leverage and financial efficiency to help you recapture money that is flowing through your life, through the way you buy your cars, through the way that you pretty much pay for anything significant in your life if you do it the right way. And so, I think that's really important to understand is, if you're doing it the right way, you can recapture literally hundreds of thousands of dollars in your life. And so there's a guy here, he wrote, Mark Perry here wrote, it's not really an asset unless it's used to create a stream of income. So he basically was saying that, okay, an asset it's not an asset is what he said, unless it's used to create a stream of income. So I don't disagree with that, right? I think, this is the Robert Kiyosaki, Rich Dad, Poor Dad, cash flow quadrant concept is, it's why the people, and myself included, say your house is not a primary asset because it's a liability because there's an expense. Now, at the same time, so it's hard because we speak out of both sides of our mouth, or at least I do in this instance, and I'm fully aware of this, and I take full ownership of that because it really just depends on the context of the conversation. When we talk about an asset from a wealth creation perspective, we're talking about it from the perspective of what is going to be creating more cash flow in our lives, what is going to be creating more value in our lives. And, from that perspective, he's right. Your car is not an asset. He had another comment basically saying that a depreciating asset is an oxymoron. Well, it's not the case because, like, think about it this way. If we were to do like, a net worth statement, I'll just do net worth statement. What is a net worth statement? It's assets minus liabilities equals your net worth, right? So if assets minus liabilities equal your net worth, so if you have a car minus the loan, so it'd be car value minus a loan equals net worth created in that car. Now, it's a decreasing asset. It's a depreciating asset because this car value is going to go down every year. Yes, this loan's going to go down every year, but typically the car value goes down faster than the loan value. And so that would equal your net worth. But if you paid cash for the car, well, then there's no loan. So it's all whatever the car value is from a net worth perspective, right? And so when you look at it like that, it just makes sense, right? Whoa, hey, it's blurry. Let's see if it focuses on me. Let's reset this. Is that going to work? We'll see. All right, it's not working. I'm a little blurry. It'll catch in. Wow. Anyway, the camera will catch up. It usually does. The autofocus is just weird. So, um, yeah. So with that logic, holding stock would not be considered an asset. That is true. That is true. I agree. And so I would say this is that, like, if we just look at, you know, if we just look at things, we have to look at things from the perspective of, I guess, two different lenses depending on what your goals are. Yes, we want to be creating wealth, through buying cash flow producing assets, and at the same time, we need to understand what our net worth statement looks like, and we also need to understand, how are we operating as efficiently in life as possible. And there are things that we do in life, no matter what, listen, I'm not saying you can get rich by going and buying cars. That's I think one of the most misrepresented components of infinite banking. I am saying that if you're going to buy that car anyway, right? If you're going to take that vacation anyway, if you're going to make that major purchase, buy that boat, buy that RV, buy that trailer, buy that whatever that asset is, and I'm going to call it an asset because if you pay cash for it, it's an asset, right? Because you can sell it and recapture capital. It's not it's not a cash flow producing asset. It's not going to be something that makes you wealthy unless you're buying a car or a trailer, an RV that you're going to rent out and unlike Turo or Outdoorsy or something like that, and you're going to create cash flow. If you do those things, well, then they're obviously assets, right? They're cash flow assets. And in that context, they're fantastic. But aside from that, they're really not. And so you need to really just understand, you look at it through those lenses. And it's hard because there's a lot of differing opinions, and on like, my opinion is the truth is somewhere in between, right? Like that's the reality in my opinion. So, all right, let's move on to the next. I'm going to try to find another question here. All right, somebody made a comment, iBonds, 9.2%. I don't know if you can see that in the chat, but I did a video talking about don't invest in bonds. It was a short video. Don't invest in bonds or CDs. Do this instead. And basically, this instead was talking about putting your money in a whole life insurance contract, saving your emergency fund inside of a whole life insurance contract instead of bonds, because you could basically get bond equivalent returns with complete liquidity from a long-term perspective. And usually, let's face it, when we're talking about personal finance and risk, reward, and returns and whatnot, we're basically usually saying if you want to have liquidity, and if you want the liquidity, you're not going to get the good returns, or you're not going to get guarantees. You can get good returns with good liquidity, but you're going to be taking on a lot of risk. But if you want the liquidity and the safety, it's not going to happen, right? Like those things are hard to find. Whole life insurance policies, when properly designed, are the only financial tool in the world that will give you the liquidity and give you the guarantees and give you the returns from a long-term perspective, and give you those guarantees that help you get where you want to go. And so this guy wrote in here, iBonds are 9.2%, and that's fine. I don't know if you can see my comment there, but the iBonds, while they're great, they're also very limiting. You're limited to $10,000 on iBonds that you can contribute to the iBonds for both yourself and each entity or business. But it's important to know that, iBonds are just very limited. So you're limited to $10,000, and they're also very liquid. So it goes back to the conversation. You have to hold them for a certain period of time. And so they are fantastic. I think everybody should have money in iBonds to a certain extent. The $10,000 threshold is great, unless you're somebody who's just kind of starting your journey and looking to save and start this process, in which case the liquidity of that $10,000 is going to be more important for you than other people. And so in that case, I think it's important to make sure that you think about your financial structure in a way that's going to help you retain that liquidity. But for other people, if you have assets that are solid, then I would say that iBonds are great. What are my thoughts on MPI life insurance IULs? Oh my gosh. Okay, so I'm going to stop sharing my screen here for this one. So Oscar, I have a lot of content on this topic. I have a very, very strong opinion about IULs. I've got 64 videos in a playlist training people, I think, on Index Universal Life. Here's what I'll say. I actually let me do this. I'll try to do this a little bit here. And the whole idea, here's MPI. I'm going to give you MPI in a nutshell. Okay, you take your money. Let's say you take a $10,000 premium. You basically pay that premium year 1 through 3, and you're paying $10,000. Year 3, starting in year 3, you then start a second policy. It's not even a second policy. He calls it a relock, which is basically taking a loan, because in year 1 through 3, you're going to have contributed $30K. You'll probably have $20K liquid. Right? So out of this, you're gonna do a relock starting as soon as you can, and you're gonna borrow against the policy. You're gonna take a loan against the policy, and you are gonna basically get more life insurance, which is gonna equal more cash value, right? That's the idea. So here's what I have to say about it. MPI and the relock is that, here's the deal. It's just an Index Universal Life policy, and what he champions as the great part about MPI is actually its greatest weakness, right? You know what I just realized, and I apologize, guys. I didn't have my my audio set up right. So I just want to make sure that you guys can hear me okay. My bad, guys. I apologize if you can't hear me. Can everybody hear me okay? Can you give me a 1? Like when I'm talking, because I didn't set up my audio. I didn't set up my audio right. So can you give me a 1? If when I'm back here, can you hear me okay? If not, I'll take a minute to set up my audio and get it right. But it'll take me like probably 60 seconds to set up my audio. Give me a 1 if you can hear me. Okay, audio's fine. All right, we're cool then. So I'll just keep going. I won't get distracted with that. So here's the deal with MPI. When we look at this, what Curtis Ray champions as the best part, the saving grace of MPI, is this relock feature. But really all the relock feature is taking loans against your policy, against your cash value, getting more life insurance, and allowing you to basically use positive arbitrage to get where you want to go. Now, here's the problem with that. If you understand that IULs, when it comes to taking loans, that 50 basis points of arbitrage on an illustration, I don't know. Have you ever seen, like, so I guess let me ask this. Have you ever seen an illustration and really read one of Curtis Ray's illustrations on MPI? Like, I guess that's my question. Here's the deal. I tell you what, I'm gonna pull one up. I got one. Give me 1 second. I'll pull it up. This is pretty fun. I have an MPI illustration. I just gotta find it. I just have to find it. At the end of the day, here's the deal. Let me see if I can find it. Oh, I hope I can, because this is gonna be good. Oh man, I don't know if I can. Well, let me see if I could do it without sharing people's personal information, because I don't have it redacted. I don't know if I can or can't. No, I can't. Bummer. I want to show it, but I can't do it because it's got people's personal information on it, and I cannot do it without redacting information. I just can't do it. But so here's the deal. If you look at the illustration, and I'll do another video. I'm working on another video on this, and so ultimately, if you look at an illustration, it shows that MPI works really well on paper because there's 50 basis points of positive arbitrage, right, with what I'm showing. But the bottom line is you're never going to have that 50 basis points of positive arbitrage. And what happens is, as we get this example with year 1 through 3, what happens is, as you get older, remember, you have your premiums building, but you also have loans that are building, right? So he kind of shows like on paper it works because there's 50 basis points of positive arbitrage all the time. But when we go year 1 through 10, right? So if you started year 3 taking loans to pay let's say $10,000 to pay more premium, by year 10 you have 70,000 in loans plus interest of 4%, right? And that all adds up. Now, what happens is, yes, that works if you have a positive 50 basis points of arbitrage every single year. But what the problem is, imagine if you started this at 35 years old, right? By the time you hit 65, you're going to have literally I don't know the numbers, but like you're probably going to have 500,000 to 700,000 in loans. So here's the deal. Not only this, because of the loans, your net amount at risk is going to be high. So everything he's showing for income works because of the positive arbitrage, but it's never going to work that way. The only guarantee about MPIs is never going to illustrate, it's never going to perform the way he's showing to you. That I promise you. And it has nothing to do with MPI. It just has to do with the fact that we're talking about loans, we're talking about the net amount at risk, and then we're talking about trying to get the cash flow out of it. It's the biggest smoke and mirror show in the industry, in my opinion. And so when we get there, when you start taking income, imagine you have a negative year in the index. Well, guess what? You have a 4% expense on this $500,000 to $700,000 loans. That's going to negatively impact your net amount at risk. So if you're 65 and we're doing annual renewable term, now your cost of insurance is going to go up every year, goes up. You have an extra expense of 20 to 30,000 just to maintain the loans, because in a negative year, this expense is real. And so while it shows a positive every single year, it doesn't account for when you have a negative 20,000, that increases your net amount at risk, which increases your cost of insurance. And we talk about compounding in a positive way. He's always be compounding, but this will compound against you. And when you're in retirement and that happens, it will blow up in your face. I've seen it happen. And I'm not attacking MPI in this instance. I'm attacking Index Universal Life. That's what I'm talking about. This is a principle of how Index Universal Life works. His MPI concept is just a game that's been able to game the system and math on a spreadsheet to be able to show that, oh, hey, as long as 50 basis points exist in an MPI policy, this can work. But the bottom line is life doesn't exist on a spreadsheet. And AG 49B, regulation AG 49B is going to come out. I talked to Bobby Samuelson about this. If you haven't checked out lifeproductreview.com, go check out lifeproductreview.com. But I talked to Bobby Samuelson, and hopefully he's thinking AG 49B is going to have new regulations in there that eliminate the ability to illustrate positive arbitrage inside of IULs, which will take MPI and completely annihilate it. And so that is, the regulators are doing this because they are seeing that this is the problem. Now, the other thing I will say is that upside potential, downside protection inside of an IUL. The one thing I love about the Mutual of Omaha IULs in the illustration is they explicitly say in there, when we talk about upside potential, we're not talking about market potential. We're talking about upside potential as it relates to a traditional universal life. The reason I always say MPI is like putting lipstick on a pig is because Index Universal Life policies will never perform. They will never perform the way that they say they will. They're just universal life products. And does everybody here, give me a 1 here if everybody understands how Index Universal Life truly works, like truly works. If you could explain to your clients, actually, sorry, don't give me a 1 on this yet. I need to know this with everybody watching. Give me a 1 if you're an agent. Give me a 2 if you're somebody who's thinking about buying either a whole life policy or an Index Universal Life policy for you in your life. I need to get kind of a gauge on how to handle this from a conversational perspective right now. So give me a 1 if you're an agent. Give me a 2 if you're somebody who's contemplating utilizing this in your life. Okay, so got a couple 1s, couple agents. All right, so I'll try to handle both, but keep those numbers coming in for me. All right, so it's getting pretty balanced. So all right, so let's look at it this way. out of the agents now that are watching this, actually everybody, because I don't believe you should ever invest or put your money, save, invest, put your money anywhere that you don't understand fully, right? And so my question now is, could you explain the internal workings of how Index Universal Life makes their money, how you get credited, where the risk lies, where the opportunity lies? Give me a 1 if you could explain it to me completely succinctly, and give me a 2 if you think probably the answer is no. You couldn't explain it succinctly and you don't have complete, clear understanding. I'm going to type this message to segment. I'm going to write segment just to kind of break up between the two. Ooh, I don't know why it did that. Oh, I just what the heck happened? Boom, log in. There we go. Until I met you, I thought I could say yes. That's awesome. All right, so here's the deal. Here's what I'm going to do. I'm going to walk through this. It's so funny. You never know where these live videos are going to go, because this is my favorite topic to talk about, by the way. Anybody who knows me will tell you that. So here's I just didn't expect to get into this today. So here we go. Let's so Index Universal Life is simply UL plus, which is Universal Life chassis, plus an option strategy. Okay, so this is it. If you don't understand options, if your agent doesn't understand how the options market works, then you can't do this. Okay, it's really, really important that you understand this. Okay, and so here's how it works. With a traditional UL, I'm going to write traditional, trad for traditional. Basically, what will happen is you get a fixed crediting rate. Okay, so a traditional UL uses a fixed crediting rate. Now, inside of an IUL, you'll notice that there's a fixed option, right? So in your IUL, if you chose a fixed option, then what they would do is you would basically be saying, all right, we're just utilizing the traditional option inside of the IUL platform. The IUL, the index, means you have an opportunity to participate in the market through participation through an index utilizing options. And I'll explain how that works in a second. Here's what I want to touch on this real quick. In an IUL, a lot of people compare, a lot of agents are comparing Index Universal Life to whole life insurance. Obviously, this is it's the biggest fight in the financial industry, I think, at this point in time. When you look at a lot of IUL agents are like, well, we got a 0% floor, or we got a 2% guarantee, or hey, IUL just as good as whole life, because if whole life has, is going to get you 4%, my IUL can get a fixed rate of 4%. And let me tell you why it's not apples to apples, because if I got a whole life at 4% and I got an IUL at 4%, the problem is the whole life is guaranteed. So that's a good thing for whole life. The bad part for IUL is that 4%, while this is guaranteed, what was the IUL illustrated at? Probably 6%, right? So every year that you choose the fixed option, right? Every year that you choose this fixed option, you're guaranteeing that you are underperforming illustrated rates by 2%. You are guaranteeing that your net amount at risk compared to illustrations are going to go up. Your net amount at risk is going to increase, right? NAR going to increase. So you're guaranteeing that that's going to happen. And so what will happen is that compounds against you, because if you do that right out of the gate, yeah, you can choose the 4% fixed if you want. But remember, your illustration shows whatever the rate is, right? So when you think whether it's 5.5% or 6 or 6.4%, like Curtis Ray likes to show on his MPI, or 6.2%, like he shows on his MPI illustrations, the bottom line is if you choose this 4% fixed rating, that's going to kill the performance of your policy, because you're getting a guaranteed rate under what they're illustrating. And so that's going to end up having compound effects against you. It's going to increase your cost of insurance, your net amount at risk. Remember, you have annual renewable term. And so that's the first thing that you need to understand. Now, when it comes to Index Universal Life, how does it work? Now is convenient IUL. I don't understand that comment. I don't know. Yeah, Gabriel, elaborate on that comment for me. I don't really understand what you mean by now is convenient IUL. But so here's the deal. Here's what IUL does. IUL is basically is why I say it's putting lipstick on a pig. Because remember, if we go back to universal life, traditional universal life that was created at the beginning, yeah. So net amount at risk, Hayes, is the difference between the death benefit and the cash value. Exactly. So it's the not just the cash value, the accumulated value, but the actual surrender value is what's available. So if I have an accumulated value of 100,000, if I have a death benefit of $1 million, that's a net amount at risk of 500,000 or of $900,000. But if I take a loan against the 100,000, let's assume we're 20 years into the policy and I have that 100,000. If I take a loan against that of that 100,000 of 50,000, that increases my net amount at risk because that is what it is, right? So you have to take all loans get impacted into it, right? So this is why when I was talking over here, these loan rates and how all this works, that all plays into it, right? That 4% loan rate and all that stuff plays into it. And you have to kind of take that into consideration. But here's the deal. Universal life, when you look at the history of universal life, it's a failed product. And that's why I always call index universal life a failed financial experiment, because really it's just taking a failed product of universal life that had its heyday in the 80s and then really lost its market share because people realized it was not going to work. And if you are like me and you believe history has a habit of repeating itself, life insurance companies have shown how they're going to react. They're not going to react in the client's best interest. They're going to act in their best interest, period. That's what they did with universal life. Why are they going to act any differently? If you think they're going to act any differently for IULs, I got a bridge that I can sell you. Because I promise you, it's not going to work that way. And so when we look at this, really what it comes down to is we say, okay, universal life is the fixed, right? And so basically what we're doing with IUL is we're basically saying, instead of this getting a fixed crediting rating of 4%, we're gonna take this fixed crediting rating and we're gonna buy, let's just say we have $10,000, right? Which 4% is $400. So we're going to say, okay, we're going to take this fixed crediting rating of $400 and we're going to buy an option contract with it. We're going to buy a call option. It's that simple, right? So when you look at this is why all these, here's the, how do I put this? All these different index strategies. There's no cap with par rates, participation rates, with spread charges, right? There's cap rates. There's all sorts of different indexes, different styles that you can do. But at the end of the day, this is the most important thing to understand with index universal life, is that at the end of the day, no matter what the index strategy is, you could show me 7 S&P 500 index strategies and options, which, by the way, I've seen several IUL contracts that have 8, 9 S&P 500 index strategies with different participation rates, different spread charges, uncapped rates with 4 different uncapped options with different participation rates, spreads and charges, and all these different things. It doesn't matter. It could be 1 through 10 options in one life insurance contract. But if they're all in the same index, at the end of the day, the inputs and the outputs are the same. You have your $10,000. You have the fixed crediting rate, which is going to lead to the options budget. So really the only variable of how your IUL is going to perform from a long-term perspective is what's the options budget plus what's the options cost is going to equal your well, I'm going to write cap rate, but I'll just, instead of cap rate, I'll write just IUL performance. So this is why, guys, I created the IUL challenge, because guess what? We just came through the greatest bull run of all time, right? We just came through this is no secret. The S&P had the greatest decade that it's ever had. So if IULs are sold on this great story of upside potential and downside protection, that means every IUL sold in the past decade should have outperformed the way that it was illustrated. At 10 years, at the 10-year mark, if an IUL was sold 10 years ago, it should have outperformed that illustration because we had the greatest bull run. It has upside potential, but they didn't, right? I've literally had over 800,000 views of my IUL challenge videos on all the different platforms, offering to pay agents $1,000 if they could show me one instance where they succeeded with this, and they haven't been able to do it. And the question that I have is why, and the answer, I'll give it to you, is because of this. It's because it has nothing to do with what the S&P does. It has everything to do with the options market and the crediting rating strategy. And at the end of the day, the options budget, the crediting rating has gone down, and the options costs have gone up. And I got news for you, even going forward, as the options budget may go up, because let's face it, the fixed indexes are going up, the fixed market is improving. That is fine. But what do we also? We have volatility. And if you understand the options market, options get more expensive in volatile markets. Not only that, IUL companies have created their own problem, because back when I say IULs are a failed financial experiment, remember, a lot of people like to lean on the fact that IULs were created in 1997 by Transamerica. Yeah, sure, that's the case. They were created by Transamerica in 1997, but the bottom line is they had no market share. They had less than 1% market share until 2009. Anybody guess why? Yeah, it was because after 2008, right? And so people bought into the story of upside potential, downside protection. Salespeople got a hold of this story of upside potential, which is really not upside potential in the markets. It was really just upside potential compared to a traditional UL, as it states in the MPI contract with the Mutual of Omaha illustration, which is what MPI uses for the most part, right? So average 5% over the past 10 years. That's horrible. That's horrible, right? And it probably was illustrated at 7 or 8 or 9, even something crazy like that, right? Like, just, it's stupid. And so that's horrible. And so, and if I'm him and I've got a policy like that over 10 years old or 10 years or so, and it's out of surrender charge, I'm going to 1035 exchange that into a policy, like a whole life policy, or do something of that nature that I can actually get the guarantees and have the control of the money that I want, right? But if you look at IUL, the reason I call it a failed financial experiment is because, yeah, it's 1997, but there's really no instance, right? And so from that point in time, from 2009 to today, if you look at the history, and I've done, I did what I think is a really, really amazing video on Index Universal Life versus whole life insurance. And it basically gave the history of Index Universal Life and the different regulations and the different performances. But ultimately, cap rates have done nothing but come down. Regulation has changed. IUL carriers keep adding different things like multipliers and uncapped indexes, which are very, very much smoke and mirrors. They've used proprietary indexes. They've done all these things. And every time they come out with one, they have AG 49, AG 49A regulations that keep forcing the insurance carriers to change the way that they're able to illustrate. Regulators are trying to get ahead of them. Every time they do, the carriers come out with different illustration tactics to get around the regulation. And so honestly, I like to give the agents a hard time, but at the end of the day, it's really, a lot of the responsibility of this falls on the illicit practices of the insurance companies themselves. And that is the problem. And so when I say they're a failed financial experiment, it's because 2009 is when they started getting market share. Now they're one of the highest selling products. They're the most profitable product for life insurance companies. This is the other thing I like to say. How could a life insurance company pay higher commissions, right? Have more profit and give better returns than whole life? They can't. If you believe that they can do that, you're probably in the wrong place. You know what I mean? Like, so what I can tell you is that the reason I call them a failed financial experiment is because there's a history of just performing worse and worse and worse and worse. And I call it putting lipstick on a pig. I call it putting lipstick on a pig because of the fact it's just a universal life chassis with an option strategy attached to it. And what's happened over the past decade, one of the greatest things that's happened that's hurt the options cost. Because if you understand options, it's supply and demand, right? There's a lot of supply and demand. When volatility goes up, a lot of speculators get involved in options, and that's what drives up demand, and that drives up the cost of the options, because options availability are limited, right? It's important to understand this. There's a limited amount. There's not this indefinite amount. So the more people get into it, the more the costs go up. And guess what's happened? In 2009, there were 11 companies. Now there are 70 plus companies selling IUL. 70 plus companies selling IUL right now. Think about that. Now we have 70 plus more. So what does that mean? They're all buying more options. This is the reason, by the way, that they've started creating proprietary indexes to try to reduce their costs of options, but they're proprietary and there's a lot of risk. There's a lot of garbage indexes that you as the policyholder don't have control of. And there's not a lot of transparency in the way they actually perform. And they've used fictitious lookbacks. I could create a proprietary index if I were an insurance company, and I could do a back test and I could cherry pick to create the returns to make it look really sexy so it would illustrate really well. But just because I do that doesn't mean that's how it's going to perform in the future, right? And they state that they are very explicit in explaining this in the illustrations, but nobody ever reads them. Or if they do read them, they kind of dismiss it away. The agents do, which to me is like malpractice, right? And so that is the problem. And so insurance companies, Wealth Wisdom Financial just said they transfer the risk back to the insurance companies, and that's what I learned, and that's one of the biggest reasons that I got out of selling Index Universal Life is because of the fact that I realized that the only reason insurance companies created UL and IUL, they're pitched as this big benefit for clients. The way, you listen to Doug Andrew talk about it, it's ridiculous. They're pitched as that, but the bottom line is they really are just a way for the life insurance company to transfer the risk of the guarantees from them, the insurance company, back to the policyholder themselves, right? So if insurance companies are designing products in their own best interest, how is dividend paying life insurance different, Chris? All right, so here's the deal. I always say this: life insurance, like when you are working with a participating mutually held company, you as a whole life policyholder with a participating mutually held whole life insurance company, you are a business partner. You effectively are a shareholder of that company. Okay. With an IUL, now IULs are sold by both mutual companies, which is sad in my opinion, and stock companies. And so remember, there with a stock company, the responsibility is not to you, the policyholder, it's to the shareholder. So if you buy or even if you buy an IUL, this is the thing. There's a lot of agents out there selling the fact that, hey, you should get an IUL. Like I'm just going to use Penn Mutual as an example, because they have an IUL. So you get an IUL with Penn Mutual, right? IUL, get an IUL with Penn Mutual, and Penn Mutual has been around. They've never missed a dividend. They've done all this stuff. They borrow the financial history and success that whole life has had, and they kind of bastardize the concept. And they say, well, look at how amazing it is with IUL. Well, it's a completely different story. If you buy a whole life policy if you buy a whole life policy with Penn Mutual, you're a business partner with them. You're a shareholder of Penn Mutual, and you get paid a dividend based on the performance of the general fund and then sharing in the profitability of the overall profitability of the company. That is what creates a dividend for a whole life policy, and it's fixed. Life insurance companies aren't going to get you great returns, but they're going to maintain your purchasing power. But with an IUL, if you bought it with Penn Mutual, you're going to be just doing this strategy. And guess what? These cap rates, everything's going to be what it is. Your insurance charges, your admin fees, all that stuff, you are a profit center for Penn Mutual. And if Penn Mutual has guarantees of whole life, and then you are in there as a profit center for an IUL, they can utilize your IUL to meet all the guarantees and the demands that are put on them from whole life. Think about that. So in a way, I tell people, that's something that it's very it's scary, because you're damned if you do, damned if you don't, and it's misrepresented a lot of times in the companies that are what are the pros and cons of whole life? Dave Ramsey rips whole life apart. Yeah, Dave Ramsey. Oh, I don't have enough time to get into the whole Dave Ramsey thing, but here's what I'll say about Dave Ramsey. Here's the deal with whole life insurance with Dave Ramsey. He just, I think there's a massive conflict of interest with Dave Ramsey in his opinion of whole life insurance. Here's what I'll say with whole life. Here are the pros and cons of whole life. The pros and cons of whole life is, the pros are, It's a forced savings vehicle if you do it right. It should be. The funny part about Dave Ramsey is he always says people should have an emergency fund, right? So Dave Ramsey is the first to tell you that you need what? 6 months. 6 months, not 60 months. 6 months emergency fund, right? So this is what Dave Ramsey says. So my question to you is, if you agree with this, and believe me, I wish I could get Dave on a debate, and I would love to have this conversation with him. If you need to have 6 months in an emergency fund, the question then becomes, where do you want to save it, right? If I could show you a way, this is where Dave Ramsey is massively led. Where Dave Ramsey is massively led or misled. And listen, I'm not blaming him completely, because it's not all his fault, because most agents don't do this the right way. Is that Dave Ramsey says he compares whole life to an investment, right? So whole life is not an investment. Whole life is a savings account on steroids. And if he would get that, he would realize that, like, hey, you need to save money. You need an emergency fund. You should have an opportunity fund. You need life insurance at the beginning. And even when you get later in life, when you don't need it, you're probably going to want it from a tax advantage perspective. There's a reason wealthy people have more life insurance than not wealthy people, because they understand it's not what they need, it's what they want based on the advantages that it provides them. And so if you believe you need 6 months, the question then becomes, where should you save it? I'm not talking about, don't look at whole life as an investment. It's a savings alternative, right? Now, it's a forced savings alternative. So where people get in trouble, the cons of whole life is if you stretch yourself too much and you're trying to save too much money and take too high of your income and put it in there, well, then you can run into problems. So, but if you have a forced savings account, if I could show you over on a guaranteed basis how whole life over a 6 or 7 year window is going to have more liquidity than your bank would have, i.e. you're going to have more money in your whole life account than you actually contributed, which is going to beat a traditional savings account. Plus you're going to have death benefit. Plus you're going to have living benefits if you become chronically or terminally ill, if you have 2 of 6 daily living activities that you're not able to adhere to or to perform, or if you become cognitively impaired, or if you're diagnosed with a terminal illness of 12 to 24 months, depending on the carrier, of being diagnosed with terminally, you're going to get access to the death benefit while you're alive. And so you can utilize that for alternative medical treatments. It's one of the things that we utilized for my father-in-law when he was diagnosed with pancreatic cancer. We had the ability to tap into this and leverage and get, natural treatments. And he's alive 2 years later, which anybody, if you understand pancreatic cancer, that's astounding, right? To be alive 2 years later, usually it's the chemo and the radiation that kill you, right? Because of the doses that they have to do. But because we had the cash, because we were able to do this and go out and do alternative natural treatments, my father-in-law is still alive, playing golf 4 days a week. Actually, he's not playing golf right now because he just had foot surgery, but that is what it is. So if Dave Ramsey understood that, life insurance is not an investment, it is simply an asset, it is a savings account on steroids. And if you believe you need 6 months, then you would understand that there's no better place to keep your emergency fund than whole life insurance. The only downside is not designing it properly, A, and B, trying to do too much, like stretching yourself too much. And we could show premiums, let's say you wanted to save $1,000 a month, right? Out of this $1,000, a lot of times people just don't understand what they do. And so Dave would say, well, don't pay $1,000 a month into whole life because you're not going to have any liquidity. It's going to take years. Well, I could show you how you could have month one, if you put $1,000, you could have $800 liquid, right? So, and not only that, that's month one, right? Month one. And by the end of the year, you're probably going to have, $9,000, $10,000 liquid, something like that out of it. And by the year 2, it gets better, 3 better, 4 better, 5 better. And so there's a little bit of a short-term liquidity gap, but it gets better and better and better. And we're not doing this for the short term. We're doing this from a long-term perspective. So we got to think long-term. We got to make long-term financial decisions if we want to be successful. And it's an increasing line of credit at a super low cost. That's the thing. Like, especially right now, like we work with a carrier that has a loan rate of 4.08%, right? And it's tied to the Moody's bond average, right? And so contractually, this 4.08%, which by the way, 12 months ago wasn't super sexy, right? Like, because we could go get a line of credit for 2%, 2.5%, right? And so that is what it is. And so now the Moody's, the bond rates go up. This can only go up at 50 bips per year, maximum. So next year, we have access to borrowing against our policy at 4.58% when the rest of the world is going to be paying 7, 8, 9% for stuff. So money is getting cheaper and cheaper and cheaper. It's pretty freaking amazing. Explain the cost of insurance aspect of whole life. It's not the annual renewable term of IUL, right? So this is where a lot of IUL agents will say IUL is cheaper than whole life. No, the difference is they basically, with whole life, they take your total insurance and they say, all right, we're going to insure you to 120 years old, right? And with that, they say, okay, we know that your cost is going to be X. And they level that out year, let's say you started at 35 years old, they're going to level that out until when you pay. So this is where if you want to pay till 99, they're going to take the cost and they're going to divide it, take 99 minus 35 is going to be what, 64. So they're going to take that total expense, divide it by 64 years, and that's going to be your COI every single year. It's going to be level in a whole life policy. It's guaranteed. It's contractual. It's level every single year. With an IUL, it's annual renewable term. So whatever that amount is, you choose the death benefit. Let's call it 500K. And you get to choose what that is. But that means your cost of insurance goes up every year. Now, agents that sell IUL speak out of both sides of their mouth because they're going to say the net amount at risk is going to go down. Well, no, it's not, because they usually choose option B, which is an increasing death benefit. So as the cash goes up, so there too does the cash goes up, the death benefit goes up with it. So you keep that $500,000 of death benefit. That allows you to put more cash in, which is why they do it. But when they do that, the bottom line is it injects more risk into the policy, because the annual renewable term gets more expensive, because if you understand annual renewable term, it gets more expensive every year. And so that is what it is. And it doesn't look horrible, especially if you're 35. You won't really start noticing it until you're 50 plus, when it starts to get bad, where you really have a significant amount of risk. But let's face it, you're buying these for the long term. You have the most risk when you start borrowing against it and having all these problems, which is during retirement, or if you're doing an MPI policy, you're starting to take risk immediately. And then you have loan risk, you have, the policy lapse risk is pretty significant. So understanding those two differences, those nuances between whole life and IUL, it's like people saying that IUL is cheaper than whole life is the biggest like lie, because I can show you in IUL, I could show you how the ART, the whole idea here, actually, let me say it this way. I'll say it this way to hopefully give more clarity. So the idea is, most people say option B until you're 65 through 65 years old. And then at 66, you go to option A, which levels it out, which will level the death benefit out. So they say, while you're funding the policy, go option B and then go option A as soon as you're done funding the policy, right? That's the idea. And that's how they mitigate their risk and say, hey, you're protected, because, once you start borrowing against it, you're going to mitigate that risk. But the bottom line is, when you're 66, if you got 500K of life insurance still, and the annual renewable term, let's say now you decided to take a $30,000 loan. Now let's just say the market did a 0 that year, and you got a 4% loan on this. Now you're going to have a loan expense, your annual renewable term, because the market underperformed. You have other costs, admin fees, all that stuff. Now your ART based on 500,000, because you have this loan, because the market didn't perform to give positive arbitrage, this is actually going to be negative. This $30,000 loan is going to go to like 31,200 at 4%, right? And so that's going to be there. So now you got $531,200 of net amount at risk. And now when you're 67, you have that. Now, does that look like a huge deal? No, but now at 67, because you're a year older, it's going to be more expensive, and you're also more expensive there. And if you have 2 or 3 years where the market is flat or under the 4%, 2 or 3 years in a 10-year period when you have loans out against IULs, decimation, complete decimation. And it's just math. You know, I've talked to Curtis's team and stuff at MPI, and they say, oh, we've tested it and it's got to be 8 years in a row of negative years. That is the biggest load of malarkey I've ever heard in my life, period. So, all right, let me see. Most illustrations I've seen whole life, I see no cash value available in the, so JDL, dude, you're right. Like, that's the sad part. This is why I do what I do. This is why I love doing what I do. Agents don't know what they're doing. 99.2345% of agents, I would say probably, I don't know, 10 to 50 agents out of 1,000 agents actually know what they're doing. That's it. Like, it's really a sad statistic. This is why I do what I do. This is why, listen, I've been doing this channel for, I don't know, since 2016. I wasn't able to really do anything about it. You know, I gave up my licenses. I just focused on, like, I did this content because it's what I was doing in my life. I like to share it with people. I like to serve people, kind of a pay it forward mentality. And then I had a group come out and say, hey, Chris, we need to create an agency around this and be able to really coach people how to do this the right way. We want to partner with you. And so that's why I've done what we've done, and we've partnered, and we're doing some really, really, what I think are amazing things, you know, in helping train the industry. I'm putting together programs. We've got live training for our agents 4 days a week now coming up starting next week. And we've got a lot of really cool things happening, you know, at the end of the day. And, you know, when you look at this stuff, I think it's so important to understand it. Designing these things is the most important thing. So, you know, when it comes back to the Dave Ramsey question, JDL, my question, I guess my answer to Dave Ramsey is, if whole life insurance doesn't have the cash value in it, it means people are doing it wrong. And in that instance, if you're utilizing it as an asset, right, at the same time for a savings alternative, I will never say it's an investment alternative because it doesn't have the same risk profile as an investment. But if you're utilizing it as a savings alternative, Dave Ramsey's right. Like, most agents don't do it the right way, and that there lies the caveat. And so I get a lot of people that respond to me in my comments and it's like, oh, if it needs to be properly designed and structured and you have to rely on the agent to do it right for you, that means it's a scam and you shouldn't do it. Well, it's like, that's the most broke mindset I've ever heard in my life. I mean, you could say the same thing about investments, and, you know, I could say the same thing about mutual funds. You should never invest in mutual funds because some advisors, some people are paying 2.5 to 3.5% annualized fees to manage their money. Like, just because some advisors are ripping people off, does that make them horrible? No, it makes them they're horrible for other reasons. But like, there are ways that you can buy cheap, no load index funds, you know, and ETFs and different things like that, that if you wanted to do that, you know, it's never where I'm going to put my money, because I just don't believe in giving up control of things. And I believe the market is cyclical, and I want to be able to take advantage, because that's when people make money during the cycles, and you know, that they make fortunes during the cycles. And so that's kind of what I would say, you know, like, here's what I'll say. I don't know if I can show this because it's, let me see if I can pull up something here real quick. I want to show a whole life policy, like just an image, that, let me see. I'm going to pull something up here. Give me a second. I'm going to show you, JDL, image snapshot of a good whole life policy. Okay. All right. So this is going to be fun. All right. I'm going to take this and move it over here so I can share it. Let's see if I could do this here. hopefully you guys, this is big enough. I can't, like, it's not, yeah, that works a little bit. All right, let me see if I can do this. Sorry I wasn't really prepared for this question. I'm just trying to make it work here. All right. Can you see this? Oh, let's see here. Bang. All right. So can you see this? This illustration right here. So this is basically showing, I was working with somebody, with one of my agents, basically had a guy that had $100,000 sitting in a savings account. He didn't want that money sitting there. He had $10,000 that he wanted to contribute every single year. He's a young guy, 35 years old, as you can see here. For this situation, $110,000 went in year one. Current dividend scale, he's going to have liquidity of $101,803 immediately, and he's going to pick up $1.78 million of death benefit. Now, check this out. Year two, he puts in $10,000. Year two, check this out. I would say, JDL, like if you have any questions, I don't get into any specific contract stuff. You can always email me, chris@life180.com, and I'm happy to have to learn more about kind of you and your business model and what you want to do. And then I could kind of guide you from there. I am happy to help you and guide you because as you can probably tell, I'm pretty passionate about this stuff. So, even if it means not working with me, like I'm all about doing this the right way. So email me, chris@life180.com, and I'm happy to kind of guide you in the right way and give you some ideas of carriers that you can do this stuff with. And ultimately, once again, I could list off, by the way, side note, I could list off probably 8 carriers that can do this, right? That have the ability, maybe not to do this, by the way. This is a company that's really unique in doing it, that you can jam a ton of money in and have a high liquidity. But the bottom line is, I could name a lot of companies that are pretty close to this. But it doesn't mean that they're going to teach you how to do this. That's the problem. Most companies don't teach you because it means there's a lot less profitability for the company and for the agent in doing this. If by designing a policy like this, the agent is taking a very significant pay cut, right? And so you just got to look at it the right way. And this is why I train agents just to rethink how you make money doing this. Because if you try to go into this selling a policy like this, thinking you're going to make traditional commissions like a whole life agent on these kinds of premiums, you're going to be sadly disappointed because the money is not nearly as good when you sell them like this at just full transparency. So if you're an agent looking to do this, and I think that's one of the reasons that this does have a bad rap, because a lot of agents are not willing to take that commission cut to do what's right for the client. And I'm of the mindset is like, hey, I just want to serve people. And if we as an agency and a culture are able to do this the right way and serve people, that in turn will come around and pay for itself in spades through referrals and through good business and through good relationships and, solving big problems. The bigger the problem you solve, the more money you can make. And that's, by doing this the right way, we're able to attract higher net worth people because it solves greater problems. The people that understand money understand the value of this. And that's why the average policy that our team is doing right now is monstrous, because of the fact that wealthy people, successful people get these concepts, whereas less successful people are still trying to figure it out and they're indecisive and don't take action and all these different things. The whole life policy is absolutely an amazing, Gabriel. It's an amazing place to build capital, to save. It's a forced savings account. I'm a big believer. The first thing that people need to do is save before you invest. And the hardest thing that you can do is save that 1 year of income. That's going to be the hardest thing in your financial life, your financial journey. I have a video coming out in about 8-9 days on this that's in the pipeline. And it's it talks about the importance of cash flow and saving before you go and invest and take a lot of risk on, so you can actually make investor type decisions, right? So getting back to this, though, I want to show a couple things. So remember, we got $100,000 front load into this, $10,000 a year premium. So $110,000 going in first year, $101,800 is the net cash value after year one. That's year one. Okay. Year two, you're contributing $10,000 in premium right here, right? But the policy grows by $10,953. So it's year one is the only, you give up, just over $9,000 or $8,000 of liquidity that you give up. But look at the benefits you get from there on. You have the life insurance by year 5, you're basically break even pretty much to the dollar. And you have all this extra life insurance. You have the liquidity of this column the whole time. Year 6, you start to be ahead. And like, I'm going to tell you, you're like, if you think that a savings account is better than this, I really don't know what to tell you. Like, you probably deserve to be broke the rest of your life. Like, I don't want to sound like a jerk, but like, if this doesn't make sense to you, if this doesn't make sense to Dave Ramsey, you could take all Dave Ramsey's emotional, manipulative statements and tactics and light them on fire, as far as I'm concerned, because the bottom line is, this is what it is. Like, when you look at this, sorry, my monitor that I'm looking at is up here, so I'm like pointing to it, but this is what it is. You know, there's no way around it. Like, and so there are several companies, like I said, that you can kind of pull this off with, but like, at the end of the day, give me a 1 if that makes sense in the comments. Give me a 1 if that makes sense. Give me a 2 if you need me to elaborate on it more, or maybe ask a specific question on the numbers that you see on the screen there. If you have any questions about it, because I don't want to like go on and on and on about this. But you know, okay, that's awesome. I'll give it a second. So I'll stop sharing it then. All right, that's awesome. So anyway, I hope that helps. I hope it gave some clarity. I am going to have to get going here. I have another meeting starting up here shortly. I just wanted to hop on. I'm going to try to do these lives like at least once a week, where I'm doing these Q&A sessions. I'm going to try to schedule them for Friday morning. Friday can be tough for me sometimes, because when I have to speak and travel and whatnot, travel days are typically Friday mornings. And so when I'm not traveling, though, I will be doing these lives. And so I encourage anybody, when you watch any of my content on any platform, whether it's Instagram, LinkedIn, YouTube is pretty much where most of the stuff happens. Comment, ask questions. The point of this live session today that I'm going to be doing is responding and engaging and taking those questions to help create content. So the question of why does it drop significantly? So I'll go back to it real quick and I'll explain it. Great question. So you could see here, and I'll get my face off here. So let's see here. Does it? Yeah, let me do that. Bang. So it's a little bigger for you. So you can see here, the death benefit drops significantly. The reason is because we funded this with a 15-year term rider to allow us to do a lot of a dump in, right? Like a big dump into the policy. So we utilized a term rider. It was a 15-year term rider that we had on this. That term rider dropped off at this point in time. And so, but because of this, you can see the policy, actually, we want to have this term rider on for as short a time as possible. Now, in this instance, let's say, I mean, it wasn't the case. This guy was 35. He didn't have kids. He didn't need the term rider. The term rider was simply on there for cash efficiency, period. If somebody has an MPI policy, do I have an exit strategy? Let me finish this and I'll get to that in a sec real quick. So here's the deal. This was built for cash efficiency. The term rider was simply a vehicle that was leveraged to allow us to put this much cash in to do it. So we wanted it to drop off as soon as we could, ultimately being able to fund it for this long. And by doing so, whoa, hey now, what did I do? What did I do? That's crazy. But by doing that, it allowed us to fund it at 10,000 for that long. And then you could see 8,572 thereafter, which allows a pretty good funding, mechanism from a savings alternative. Remember, I wrote my book, Cash Flow Hacking. It's all about leveraging this as a liquid accessible account, so you can put it into other assets. This is not the investment. This is the savings alternative. Thank you, babe. This is the savings. My wife just delivered food for me. So what a sweet wife. So this is the savings alternative that you are going to borrow against and leverage for other investments, whether it's a business capital reserve, whether it's your emergency fund, your opportunity fund, whether you want to invest in real estate. This amount of money is going to operate as your emergency fund. So this is where, like, once again, when Dave Ramsey says you shouldn't keep it, like, why would I keep my money in a savings account, Dave, when I can have it here and be doing infinitely better and basically pick up all this life insurance above and beyond it? It's the way to get your dollars to perform more than one function. And the fact that people argue with me on this is probably the most frustrating part of my life, quite frankly, because if people can't see this, whoa, holy smokes. If people don't see this, right, that I've contributed after 5 years, 160, and I have 163,000 available and a $1.8 million death benefit, I just don't get it. So the death benefit drops off, but you can see it keeps going, because what are we doing? We're utilizing the dividend as buying paid up additions. That is how we keep financial efficiency growing. The blend of the policy is really awesome. And this is going to grow and grow and grow and grow and grow. And so, by the time, check this out, by the time you hit 65, this policy is growing by $38,000 a year. You could basically take this as an income every single year thereafter, and it would be not detrimental to the overall policy, right? So it's really, really powerful stuff. It's not everything. The one thing I want to say is, like, you got to make sure that this is designed properly. You got to make sure it fits your needs and your goals and your objectives. And so somebody asked me, like, what's the best way to design a policy? This is why I coach. If you were to talk to anybody I coach, you're going to hear from them, like, there's no one way to do it. It really has to align with what your goals and objectives are. And if you do it the right way, then it's going to meet what your goals are. Some people have a greater need for short-term liquidity. And some people have a more of a desire for maybe a little bit of a longer term internal rate of return. There's no such thing as a free lunch in this world. That is a principle that I believe to be absolute. And so when you want shorter term liquidity, does it have an impact on the long-term internal rate of return? Yep. It does a little bit. And so that can be a negative, but you have to look at what are your goals and objectives, and what is that liquidity worth to you? What is that control worth to you? And that the answer is different for everybody. I don't know you. I don't know your skills. I don't know your weaknesses. I don't know what your education level is. I don't know where the opportunities that you're seeking are. And so that's where this really kind of comes into play. So any questions, comment in the comment section below. Anybody needs anything on any of this topics, you always feel free to email me, Chris@Life180. If I can help you, I'm happy to. If I need to plug you into my team for them to help you, I'm happy to do so. Anything you need about anything, just let me know. I mean, I'm here to serve. I'm here to help. It's why I'm doing these videos. It's why I do these lives. It's why I'm feeling kind of called and pushed to do these lives more and more often. I don't know how long you've been following the channel, but I'm doing them a lot more often, once or twice a week now. And the reason is because I think it's important. I think especially right now, the market's kind of come back a little bit. I don't know what it's doing today. I haven't looked, but yesterday was a complete nutso day. I don't understand how the market went up that high with the election results the way that they came in. It's laughable to me. I think we're coming into some really, really gnarly times. And I think what people do over the next 6 to 12 months is going to have a huge impact on the rest of their life. And I don't say that lightly. It's why I do what I do. So if you have any questions, comment in the comment section below. If you haven't already, subscribe, hit the bell, that way you're notified every time I go live, every time I launch a video. JDL, just email me, Chris@Life180, bro. CHRIS@life180.com. And you can go to my bios. All my contact information on all the platforms are there. Feel free to reach out, and I'm happy to connect with you. And I'm happy to guide. If anybody is an agent looking to learn, looking to implement this in your practice, and you want to take your business to the next level, that is where my life is committed right now. Just so you know, I'm committed to building agents. Exit strategy. So Chris, the answer is yes. There is an exit strategy. For that question, I'm going to need you to get on a call though, because everybody's a little bit different. I need you to talk to me and my team about that, to take a look, because it really depends, like, how deep into it are you? What are the surrender charges? What are the fees? What does it all look like? Are you already in the relock period? Have you taken loans against to do extra policies? Like, really understanding that is a big deal. And I don't want to give kind of like just high level advice on something that is very, very, very customized, even in that one specific topic. It's everybody's answer is going to be a little different. But if you need help and you want guidance and just clarity, me and my team are absolutely, even if it's something where the answer is we can't do it for you, like we're happy to guide you and coach you. So you can go down in the link in the description below. I think there's a clarity call link it's the Calendly link for setting up a consultation. The clarity call, you can go down in the link below and you could set up a call with one of the guys on my team, and they're happy to help you. And they'll go through, they'll evaluate, and I'll be there with them, but they will be able to evaluate and kind of give you a real assessment of what's what, with your situation if you are already with MPI. So, all right, guys, that is it. We're going to go from there. So hopefully everybody found value in this. I loved it. Thanks for asking the great questions. Thanks for the engagement. These lives are some of the most fun times of my week. I love doing it. I'm actually, if the engagement stays like this, I'll definitely be on doing this more, because I had a lot of fun, a lot of questions, a lot of engagement. It's what it's all about to me. So guys, have a blessed, inspirational day. Happy Veterans Day. And if anybody hasn't yet, follow me on Instagram as well, at Real Chris Kirkpatrick, REAL Chris Kirkpatrick on Instagram. I'm over there as well. If you haven't followed me there, I'm doing a lot more content over there as well. So that's it. Cool, guys. Have a great weekend. Crush it. Change somebody's life. We'll talk to you soon.